Latha Venkatesh as well as Vivek Rajpal of Nomura, India. Latha, first, your take on the borrowing calendar.
Well, it is almost entirely on expected lines. 3.72 lakh crore compares with 3.55 lakh crore last year. So not very different. Although last year we were borrowing only 59% in the first half, this time they've scaled it up to 64. And as Sapna was pointing out, the scaling up is also because there is a lot of redemptions that's coming. 1.57 lakh crore is getting redeemed. So if you take that off, net you're borrowing actually more like 2.2 lakh crore or thereabouts. Last time the net in the first half was 2.48 lakh crore. So compared to last year, we're actually borrowing less. The other reason why it is sensible to borrow 65% in the first half is, it is only in the second half that the state governments start borrowing. So there is more competition. Also in the second half, after the rains are over, the cement companies, sugar companies, all of them start borrowing. It is what you call traditionally the busy season. So center usually keeps it light. This time it is ultra light. One, because they know that state governments will come with all their Uday bonds and with their state government loans as well. And also they're keeping the first half heavy because there is a lot of redemption. So this looks like exactly what the doctor ordered, but let's ask the market expert. Vivek Rajpal of Nomura is with us. Vivek, from what is available, what is your comment on the borrowing program?
So, Latha, I broadly agree with you. This is in line with expectation. So I think this is very slightly higher than expectation as far as the gross supply is concerned. I think one big difference versus last year is that this time there will be no open market operation purchases. So this time the supply pressure will be felt. Having said that, it's a comfortable environment as far as the sovereign debt markets are concerned over the next month or so. So I don't believe it will create a huge issue. Nevertheless, I think because supply is there and net supply, net of OMO purchases is much higher than the previous year, I don't think this is a market to chase the bonds. Probably I would expect bonds to remain range bound, at least in 10-year to 15-year part of the curve, where supply is usually heavy.
Okay, well, just two questions, Vivek. First, in the month of April itself, where do you see the 10-year go as the borrowing begins? We are what at 6.75 now, 6.76. Where might the 10-year go once borrowing begins on April first week?
Right. No, so I don't think in April there is much of an issue. I expect, I believe 670, 690 is a kind of a zone where it will broadly, the 10-year bond will range trade. But my worry is as the months pass by, and we see a rise in inflation trajectory, which will be more visible probably beyond July, August. Yields may inch towards 7%.
Okay.
But in the near term, probably a range bound 670, 690.
Okay. Then the other major point is what you raised. This time you will not have the Reserve Bank coming in buying bonds because the liquidity is simply too heavy. Is this removing any elbow room for the RBI to sell bonds? Because one way of removing permanent liquidity would have been an open market sale of bonds by the Reserve Bank. Is that removed? So we should expect a standing deposit facility.
Right. Yes, so I expect standing deposits. I believe standing...
Is OMO sale ruled out? Elbow room for that from the Reserve Bank?
Frankly, no. I don't think market is expecting OMO sales, and I also don't expect OMO sales. Having said that, there is a talk about standing deposit facility, which is really an unconstrained way of mopping up liquidity. I think that is a much more permanent way of mopping up, or rather much unconstrained way of much unconstrained way of mopping up liquidity. Okay. If that comes along, there shouldn't be any OMO sale. Okay. Now, this borrowing calendar has any correlation with the OMO sale? I don't think so. OMO sale or standing deposit facility or MSS bond is a separate decision that RBI has to take.
No, I take your point. I was just saying that because you're borrowing 3.72 lakh crore and a little more than, as you said, the market expected, whether the elbow room for OMO sale, if contemplated, goes away. That was my limited point. Thank you very much, Vivek Rajpal, for joining us. Well, so key takeaways from the expert, very much in line with what the market was expecting, maybe a little more, but I don't think it's going to do a big jig in terms of bond yields. We were at 6.7, we'll stay there and probably obey the global yields.
All right.